Ever heard of forwards, futures, or options and wondered what they are? Today we are going to break them down super simply. These are tools in finance called derivatives that help people manage risk or try to make money from price changes. So, first, let's look at what a derivative is. Think of it like this: the word derive means to come from. So, a derivative is a financial contract whose value comes from something else. That something else could be a stock price, the price of oil, a currency, or even interest rates. It's like a bet or an agreement based on how something else moves. So, why do we use derivatives? People use derivatives to manage risk or to make profit. Managing risk using derivatives is called hedging. This is like buying insurance for future prices. And making profit is called speculation. This is when you guess where a price will go and act based on that. There are four major types of derivatives: the forwards contract, the futures contract, the options contract, and the swap contract. So let's start with forwards contract. The forwards contract is the most basic contract. It's like a private agreement between two parties. In a forward contract, two persons agree to exchange an asset privately at a specific future date for a predetermined time. For example, a farmer in a wheat factory can make a forward contract. They agree today on a price for wheat, let's say $5 per bushel, for delivery in 6 months. This is a private agreement just between them. So why does a farmer go into an agreement like this? Why? Because if he believes that the price of the wheat bushels might go down, he might protect his income by entering into a forwards contract with a bread factory company where he will be selling the wheat in 6 months with this for the price of $5 per bushel, which is the current price of it. So why is this contract private? Because they trust each other and there's no standardized exchange on which this contract is being taken place. So this contract is extremely customized, so they can make their own rules and regulations and what delivery they are going to use, and how much, what's the quantity of wheat they will be getting, or something like that. And there is no exchange controlling the contract, and the settlement is for sure at the end. The biggest risk of this contract is counterparty risk. This means that what if in 6 months the market price of wheat goes way up to $8? The farmer might be tempted to break the deal and sell to someone else for more money. Or what if the bread factory goes out of business? There's no one in the middle to make sure both the sides keep the promise. This is why counterparty risk is very high. Now, let's look at future contracts. Think of these as an upgraded and safer version of forwards. A futures contract are still agreements to buy or sell something at a future date for a set price, but crucially, they are standardized and traded on big organized public exchanges. Why standardized? Because when everyone agrees on the exact amount, the quantity, and the quality at specific delivery months, it makes it easy for anyone to buy or sell these contracts. This makes the market very liquid, meaning it's easy to enter and exit trades. So the main properties of a future contract is that it is standardized, it is exchange traded, there is a clearinghouse which manages the trades. Like a clearinghouse is a third party that guarantees that the trade takes place and there is no counterparty risk. This is the main game changer of futures contract. And the price movements are reflected every single day. So your futures account is updated based on the current market price in every day for every second. Let's say you buy a futures contract for 100 barrels of oil at $80 per barrel. The price of oil goes up to $82 by the end of the day. You have made $2 per barrel. That's $200 profit on 100 barrels and is immediately added to your account. And if the price falls to 78, you've lost $2 per barrel. That is $200 loss and is immediately deducted from your account. Why do they update daily? To make sure no one builds up huge losses that they can't pay is the main intuition behind updating daily. You also need to put some initial money called margin to trade futures. If your losses eat too much into your margin, you'll get a margin call, meaning you need to deposit more money to keep your trade open. The pros of a futures contract is that it is safe, liquid, that means anyone can buy and sell it anytime, and transparent. The major cons of futures contract is margin calls. So when you enter a futures contract with initial margin, there is a probability that your margin might get swept off. So you might have to keep on adding additional margin, making the loss unlimited. And futures contract is less flexible. Now let's look into the third type of derivatives, the options contract. This is where things get fundamentally different. With forward and futures, you're obligated to buy or sell. With options, you as a buyer have the right but not the obligation to buy or sell an asset. Why is this important? Because it limits your risk. To get this right, you pay a small amount called the premium. So in option contract, there are necessary three key terms: the premium, the strike price, and the maturity time. The strike price is the specific price at which you can buy or sell the underlying asset if you choose to exercise your option. The option is valid only till the expiration date. After that, it's worthless. The, there are two types of option contracts. The one is the call, the other one is the put. Call options give you the right to buy an asset at a strike price. Let's say ABC stock is trading at $100. You think it will go up. You buy a call option with 105 strike price that expires in 3 months, and you pay a premium of $3 per share. If ABC stock jumps to 120 before expiration, you can exercise your right to buy the stock at 105 and immediately sell it in the market for 120. You make a good profit. But if ABC falls to 90, you don't simply exercise your right. The option expires worthlessly, and your loss will be $3, which you paid as premium per share. The same goes to put as well. Put gives you the right to sell an asset at the strike price. Imagine you own ABC stock, which you bought at 110. You're worried the market may drop next month. You buy a put option with 100 strike price, expiring in 1 month, paying a premium of $2. If ABC stock falls to $90, you can exercise your right to sell the stock at 100, even though the market is at 90. You're limited your loss. This is how options are fundamentally different. They give you the right, but not the obligation. And the loss is minimized with only keeping the premium at risk, not an unlimited margin. So to summarize everything and differentiate between forwards contract, futures contract, and options contract, let's look at this table. So let's look at point one, obligation. Both parties have the obligation to fulfill the contract at the time of maturity in forwards and futures contracts. But in options contract, only the seller has the obligation. The buyer has the right, not the obligation. Now, if you look at customization, forwards contract are highly customizable because the rules are just between the two parties. So both the parties can privately make any type of rules they want. Whereas futures contracts are the least customizable because they are or highly standardized based on the exchanges and markets. So they can't be customized as a party needs. Whereas an options contract shows a little bit more flexibility towards customization because the party can choose the expiry he wants or the strike price he wants or some other details like that. The trading place for the forwards contract is private and it's between two parties. But for the futures and options contract, it is in public exchanges. The counterparty risk is very high in the forwards contract, as we discussed, but low because of standardization by the exchanges in options and futures contracts. We can only settle the forwards contract at the end of the contract maturity, but we can settle the futures contract daily, which we also call market to market settlement. Whereas the options contract are settled only if they are exercised. The cost to start a forwards contract is nothing, whereas the cost to start a futures contract is a margin, which is some percentage of the stock, the or the asset the contract is based on. And for an options contract, we should pay the premium as we discussed. The max loss in forwards and futures contract is unlimited, whereas for an options contract, it's just the premium which we pay. So this is about the derivatives, forwards, and futures contracts. We discuss what a derivative is, the major types of derivatives, what a forwards contract is, what a futures contract is, and the fundamental difference between the forwards, futures, and options contract. Thank you.